Hello and welcome back to my favorite people. Hope you're doing well. I'm incredibly excited for today's video because this is one of those simple charts that once you see it, you really can't unsee it. And because it shows such a clear correlation between US national debt in white here and the S&P 500 in red, and we know Bitcoin is incredibly correlated to the S&P 500 and other risk assets, I have found it incredibly beneficial to zoom out and remind myself of my macro thesis and why I'm bullish risk assets in the long term, because I don't see national debt increases and currency devaluation going away anytime soon. And that's the best way I have found to manage my emotions during these very choppy Bitcoin summers where everybody is losing their minds trying to figure out if we're going to crash or rally in the short term. And of course, having a longer term plan and a macro thesis also helps quite a bit with managing emotions during all these negative headlines. I mean, just in the past 7 days, we saw that Mt. Gox was going to begin repayments of billions of dollars worth of Bitcoin. We saw the German government began selling Bitcoins and they have billions left to go. We saw the US government starting to sell Bitcoin as well and they have billions left to go. We saw the SEC start filing lawsuits against crypto companies once again after taking a hiatus for a while. And if you were to just focus on the narratives and try to convince yourself that, oh, maybe we're going to go down and I should sell everything so I can buy back in, or maybe the cycle has stopped because look at all of this selling pressure that's coming, I have found so many of the mistakes that I've made historically to be a result of that type of thinking. And having a chart like this one where I zoom out and focus on the macro trend and what I expect over the next 3 to 5 years has made it a lot easier for me to stick to my strategy during all of this short-term volatility. But let's go ahead and talk more about this chart specifically. It doesn't just show us the correlation between the US national debt in white and the S&P 500 in red. It also shows us very clearly that after each and every crisis, we come out of it with a steeper slope of debt growth and debt issuance. For example, you can see in blue here the slope of the debt increase from 1990 to about 2001 when the dot-com bubble occurred. Then you can see that it steepens aggressively from the dot-com bubble to the great financial crisis in green. Then it steepens again from the great financial crisis to the pandemic in 2020. We've seen a very steep trend that has maintained ever since March of 2020 when it got started and hasn't reduced as we pulled ourselves out of that crisis, which shows us that this is really a one-way street where once the economy gets used to a certain rate of increase, it's very hard for that to get pulled back and reduced, and for federal governments to reduce spending and be more responsible with debt issuance. And now this is especially important to understand because if we know that this trend isn't going to get reversed anytime soon, it becomes incredibly important to not only look at what the Fed is doing with the Fed funds rate, but to also look at what the Treasury is doing with federal deficits. Because best believe, if we didn't have these huge deficits and this debt issuance skyrocketing, we would have entered recession a while ago with rates being where they are today for as long as they have been. If you take a look at 2001 and 2008 when we had the great financial crisis, the debt issuance during that time really wasn't that bad. We were actually at a surplus in 2001. And then as we entered recession, we went into some more deficits. And then in 2007, the deficit was pretty small, 150 billion, which in today's term is pennies compared to what the government is spending today. And then look at how the deficit increased once we entered a recession. But if you look at today, we haven't even entered a recession yet, and we're all the way down here with trillions of dollars of deficits to keep the economy afloat while the Fed keeps rates elevated to fight inflation. And now that we know that inflation is working its way down but still staying above the Fed's target, yet the unemployment rate seems to be working its way up and seems to have passed the point of no return, I'm very convinced that we're going to see a lot of volatility over the next 6 to 12 months. And if you're sitting there trying to react via news headlines or economic data reports and changing your strategy on a day-to-day basis, it's likely going to underperform someone with a macro thesis who's zooming out and trying to stick to a longer term plan where they're not going to get emotional and make decisions and mistakes on day-to-day movements. So that's why this is one of my favorite charts to zoom out and remind myself what's likely going to happen over the next 3 to 5 years with national debt and what that would likely mean for risk assets. Will there be black swans along the way? Yes. Will there be crashes along the way? Yes. But the long-term trajectory is pretty straightforward in my opinion, especially if we look at the pace we're going at today in the fiscal year that started October of 2023. So about 8 months ago, we're already at 1.2 trillion and we are likely to hit 2 trillion by the time this fiscal year ends. And of course, that's going to put a little bit of support under the economy. And that's why the labor market has been able to hold on as long as it has. And this is definitely one of the things to monitor alongside what the Fed is doing with monetary policy to have a more holistic view of the economy. But anyway, back to Bitcoin and back to more short-term charts, we still have not reclaimed that crucial 20-week moving average that we closed below last week. And for me, once you get an open and another close below a level, that's an official break. So this is an official break of the 20-week moving average, in my opinion. And until it gets reclaimed, I think more chop and more shaking out short-term investors is a lot more likely. Once we reclaim that 20-week moving average, we can start talking about upside and short-term bullishness once again. But for now, it looks like way more consolidation and way more time spent in this range is a lot more likely. And of course, that agrees with what we're seeing from the dollar index, our favorite inverse asset when it comes to correlation with Bitcoin. It still looks like it wants to slowly grind higher. 106.50 is still the very crucial level to watch. A break above there and I would brace for impact. But if we can roll over here because there's some surprise that forces the Fed to ease a little bit sooner, that could put a little bit of momentum to the upside for Bitcoin. But of course, for now, it looks like Bitcoin wants to chop more and it looks like the dollar index is going to continue grinding higher, which is not good for investors that want to see a Bitcoin mania phase and alt season tomorrow, because historically those have required aggressive drops in the dollar index, which is not what we're seeing today. And of course, if we want to see that drop in the dollar index, we need to see the Fed start easing policy like the other central banks are doing already. And as of right now, that is not expected to start until September. And of course, what would definitely help to get those rate cuts sooner would be inflation coming down more aggressively. We're still quite a bit away from the Fed's target, and the comparisons we're going to start doing year over year are going to start getting tougher to beat. As you can see, from about January to May of 2023, core PCE was kind of in a pretty tight range. So beating those numbers this year is quite a bit easier. But once you start seeing these aggressive drops in 2023, the year over year comparison becomes a lot more difficult. So it's likely that core PCE may start bouncing here because it's comparing lower and lower values from last year on the year over year number. So we'll definitely monitor these rate cut expectations and see how those change and how the market prices them in. But for now, consensus is one rate cut in September and one rate cut in December. But of course, even with all of that going on, the S&P 500 continues to climb the wall of worry. Now, we are seeing some sellers step in a little bit here and some wicks to the upside. That doesn't mean the S&P 500 has to top and roll over immediately, but definitely some warning signs for volatility and caution in the short term, because we are seeing those wicks to the upside as some sellers have stepped in at these price levels for the S&P 500. So next week will be very crucial to monitor and see how that plays out. As for Ethereum, still looking pretty solid and holding good structure. As we've said recently, we had a huge rally from January to March, retrace, and then another spike on the ETF approval rumors, retrace again. So this could grind higher here. I think the spot ETFs are getting pushed back a little bit closer to mid to late July instead of early July like we had anticipated originally. But July is definitely going to be a crucial month to watch for Ethereum, because all eyes are going to be on those ETF inflows to see what kind of demand Ethereum can receive compared to what we saw with Bitcoin. As for Solana, managed to hold the major lows that were set in the early April timeframe, but also getting rejected and struggling to reclaim that 20-week moving average. Until that level gets reclaimed, still cautionary in my opinion, and no reason to get super aggressive, but still happy with my current allocation because I do think we will get Solana ETFs eventually, even though it could be months and months and months from now. I still think this is the third blue chip asset, and I still think it outperforms Ethereum and Bitcoin in this cycle, which is why I have sized my Solana position the way I did. It's not a larger position than Bitcoin and Ethereum because I do think Solana has more risks and a lot more volatility, but I'm still happy with the allocation that I do because I do expect it to outperform in a mania phase and full-on bull cycle. But anyway, we'll see what happens. Of course, there's always going to be volatility and chop along the way, but my long-term thesis for Bitcoin remains unchanged, just like my long-term thesis for the S&P 500 remains unchanged because of what I expect for money supply and national debt in the long term. And we have to keep in mind that after each and every crisis, yes, there can be a lot of volatility and crashes when those occur, but usually to pull us out of it, governments and the central banks around the world only have one method to do that, and that's by increasing debt and increasing the money supply, which should put upward pressure on risk assets in the long term because we price those very risk assets in the currencies being devalued. But anyway, let me know what you guys think. Is there anything in this video that I said that you disagreed with, or anything I am missing in what this simple chart is trying to portray? I would love to know what you guys think and what you expect over the next few months or so. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.